Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, February 13th. Yesterday's hotter than expected US inflation print and Jerome Powell's hawkish remarks in Congress didn't sit well with investors. So the US yields jumped, but the US dollar fell. Equities somehow managed to claw back some early losses, but the rate cut hopes from the Fed are fading compared to where they stood before yesterday's data. Now, one bright spot in all this is that Donald Trump and Vladimir Putin are set to discuss Ukraine, and oil prices are falling on hopes of an eventual, if imperfect, resolution. Yesterday's inflation update from the US didn't go well, to say the least. The data actually showed a hotter than expected report across monthly and annual readings and all categories, including food, energy, and housing prices. In numbers, the US headline inflation now accelerated to 3% in the month of January instead of decelerating toward the Federal Reserve's 2% policy target. Core inflation, the one that excludes food and energy prices, and that actually matters more to the Federal Reserve under the pretext of being less volatile, well, that metric ticked up to 3.3%, and Powell said in the second day of his semi-annual testimony in Congress and after the US CPI released that they were close but not there on inflation. Now, if you ask me, I wouldn't employ the word close because it's been a while since inflation has been sticking around the 3% mark in the US, and with Donald Trump's tax cuts and tariff plans, it will hardly point its nose back toward the 2% target. And speaking of spending or tax cuts, the US federal budget gap widened to a record high for the first third of the fiscal year, as reported by Bloomberg, and the cumulative deficit for October through January widened 25%. In summary, yesterday's data, couldn't look uglier. But happily, and I'm saying happily, we are now talking about the US and not about someone else, because no one could take so much bad news on his shoulders and remain a safe haven. But that's another discussion. For now, the Federal Reserve rate cut expectations are melting like snow under the sun after yesterday's clear uptick that we saw in the US inflation data, which suggested that the Federal Reserve would better just wait and see before doing anything else. It also confirms the fact that last September's 50 basis point cut was a mistake, by the way. So the US 2-year yield that best captures the Federal Reserve rate expectations jumped almost 10 basis points yesterday after the release of the US CPI data. And the US 10-year yield, which will serve to control the borrowing costs in the US under the new US Treasurer, Mr. Bessent, jumped around 12 basis points yesterday. Gold, on the other hand, gained despite the rising US yields, and the historically negative relationship between the US yields and gold prices is no longer a thing, mind you, given that many investors out there, and that including central banks, especially central banks, now flee the US debt and replace it with gold. I'm looking at you, particularly China. As such, yes, I think that hitting the $3,000 per ounce level in gold could actually trigger some profit taking in the short run, and could be an interesting tactical play, but the medium to long-term outlook for the precious metal remains positive, and it remains positive even at the $3,000 level. Because if Bitcoin could rally to $100,000, gold could continue its journey toward, $4,000, $5,000 per ounce mark. Because also note that the US worsening diplomatic relations with the rest of the world, including allies, is not looking great for the US Treasury demand, and the fact that the US interest rates will certainly have to remain higher for much longer won't help ease the exploding debt worries for the US. And speaking of the rate cuts, well, activity on Fed funds futures now suggests that the Federal Reserve is, well, not ready to announce any rate cut at all before its September monetary policy meeting. So that's gradually deteriorated from May at the start of this year to September now. And worse, swap traders, well, they don't expect the Fed to cut its interest rates before December this year, hence, well, announced just one interest rate cut this year and not more if it cuts at all, because there are rising voices as well that the Federal Reserve's next move could actually be an interest rate hike instead of a cut. It all depends on how Donald Trump's tariffs will hit back the US consumers. And we have, well, 4 years to watch from here. I hope the world has enough popcorn in their hands for the 4-year term that just began. Now, in the FX markets, the US dollar actually didn't rise on the back of the rising hawkish Fed expectations following the hotter than expected CPI data yesterday and the rising yields as a result of it. But the greenback is swiftly offered in the Asian trading session instead, maybe due to some relief on the rising hope that a planned discussion between Donald Trump and Vladimir Putin could bring the war in Ukraine to an end, with, however, some compromises that may not necessarily please the Ukrainians nor the Europeans, according to the latest news. But because this is not a political show and I'm not a political expert, we're just going to talk about crude prices, which actually plunged 2.70% yesterday below their 100-day moving average mark and are extending losses toward the $70 per barrel psychological support this morning. Now, potentially waning geopolitical risk on the Russian front, which I would find hard to believe, the waning Federal Reserve rate cut expectations, and the tariff unknown or tariff disaster now gather dark clouds over the global economic outlook and could eventually encourage a further dive in US crude prices below that $70 per barrel psychological mark, and also pressure the price of a barrel of Brent crude toward the $70 per barrel level as well. Elsewhere, well, the US dollar's weakness across the board, despite that hot CPI read of yesterday, encourages other currencies to recover some of the latest losses. So the euro dollar, for example, jumped past its 50-day moving average yesterday and is now preparing to test a minor Fibonacci resistance. But note that the medium-term outlook for the euro dollar will remain bearish below the 106 mark, and macro traders are probably already out looking for interesting top-selling opportunities on the back of, well, this diverging Federal Reserve and European Central Bank monetary policy outlooks. Today, the US PPI data and the weekly jobs figures could eventually give reason to the US dollar bulls to pile back into the US dollar. In the equity space, the S&P 500 kicked off yesterday's trading session on a negative note, but the index actually managed to recover losses throughout the session and ended the day with just a meager 0.27% slide, while Nasdaq 100 index even managed to eke out a 0.12% advance yesterday. Now note that the rally in US equities somehow slowed since the beginning of this year on the back of this rotation trade toward the non-technology pockets of the market and the underwhelming earnings from the Magnificent Seven companies. But the rest of the index is doing pretty well, mind you, because around 3/4 of the companies in the S&P 500, they already reported their earnings, and the earnings per share grew 12.5% in the fourth quarter of last year compared to a 7% rise expected by analysts into this earnings season. The earnings beat resulted in a meager average performance of negative 0.1%, however, so that basically means that the rotation trade that we've been seeing will not be enough to offset a potential fallout if, God forbid, the big technology companies were to fall from grace. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments. Your reactions and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.